Good afternoon, students. Um, Let me try to play around and uh, move some stuff away to get out of our way, basically, if I can. Okay. So today's thought is the power of positive thought. To get to yes, I did, you have to start at the bottom of the stairs. So for those of you still feeling like you won't be able to do these accounting problems, you can. You just have to take one step at a time. That's the purpose of this motivation. Success starts with thinking about wanting to be successful, coming up with an idea to try and to do it, and to then come up with another idea because that one didn't work, and just to repeat it until you actually get to the top of the staircase. You can do anything that you decide. So don't get frustrated with this process. Once you learn, you're going to say, oh my God, I can't believe I sweated over this. Just keep going. So in chapter 3, what we're focusing on is being able, so at the end of this chapter, after you've read it a couple of times, defined all the terms, understood the content, remember to also watch the author's video because it is an outline of the written pages in the chapter. Very useful for note taking. What you need to be able to do at the end of this chapter is explain the reason for the adjusting entry process. Prepare adjusting entries themselves for both accruals and deferrals, which is what you see here. Prepare adjusting entries for depreciation, which also falls under deferrals. It's just listed separately. Then after you prepared all your adjusting entries, remember this is done after you've done your whole month of activity. So once you've done all your journal entries like you did in chapter 1 and chapter 2, which is steps 1, 2, and 3, journalizing, posting, and then getting the unadjusted trial balance. Step 4 is to do the adjusting entries. So you're going to continue with the same problem, doing the adjusting entries. And then from there, you're going to do the posting of the adjusting entries and then the adjusted trial balance. Then you have accurate numbers for balances for each of your accounts. So now you can actually do your financial statements. So you do still need to know how to do your financial statements, even though it's not listed here. They're not something new. We're repeating them. So we're doing this so that we can have accuracy in those. Calculate your book value, which is another concept that's explained in your book, and we'll go over it briefly. Know what the effects are if you do not record an adjustment. Very, very, very important. And I have some exercises to give you to review. And then, of course, define all your vocabulary. So to review, let's review our debits and credits. We know that we have assets on the left, we have liabilities and shareholders' equity on the right. We have to understand what each of these terms, because each part of the accounting equation, everything we talk about, is a new vocabulary word for you. Memorizing the definition of the vocabulary word that the author gives you doesn't help you to really understand it. So put it in words that make sense to you. Shareholders' equity is made up of the beginning balance and retained earnings, the common stock that we sell to our stockholders, the dividends that we pay them is reducing it. Revenues are increasing it, money that's earned once we complete a job or a service. Then our expenses, once we use them, consume them, or the time has elapsed, has expired, then we have to record those expenses. We need to know that a debit to an asset increases it. A credit, therefore, will decrease it. The normal, meaning the side that increases, is a debit. For liabilities, it is the opposite. A debit will decrease, credit will increase, and the normal is a credit. Retained earnings, function, and common stock both function the same as a liability. They both decrease with an asset and they increase with a credit. Dividends, however, because if you notice, dividends reduces shareholders' equity, it functions just like an asset. It increases with action and it increases with a debit action and decreases with a credit action. The normal is a debit. Because revenues increase it just like common stock and retained earnings, it functions the same. So therefore, a debit will decrease it, a credit will increase it, and the normal is a credit, the side that increases. That is the definition of normal balance. Expense, because it decreases shareholders' equity, functions just like dividends, just like assets. So therefore, an asset will increase it, a debit will increase the expense, a credit will decrease it, and the normal is the debit. If this doesn't work for you, use dead coil. If dead coil doesn't work for you, use chapter 2 chart and make your own. Financial statement review. So again, it is a focus of the chapter that you can do the adjusting entries so that you have accurate balances in each of your accounts so that your financial statements actually balance. So they're all connected. Remember, all 4 chapters are connected. They give you a complete accounting cycle. These are steps 4, 5, and 6. And then 7, because 7 will be your financial statements. So we always start with our income statement. The income statement has revenues and expenses that live on the income statement. The result of those are income or loss. Then we calculate our statement of retained earnings. To do that, we have to start with beginning balance and retained earnings. We have to bring over our net income from our income statement. Net income comes over. We add income, we subtract losses. Then we subtract dividends. Remember, on the actual page, you have some subtotals. Just like you have subtotals over here for total expenses, you have subtotal between net income or loss and dividends. And then you get the ending balance and retained earnings. Make sure you understand the format, and the date format is very important as well. There are 3 financial statements that begin the date with for the month ended, and there's one that just has the date, and you need to know the difference between them and why. Next, we're going to do our balance sheet. We're going to list all the assets, total them up. Once we total them, they should equal whatever our liabilities are plus our shareholders' equity. And we should know by now that's inclusive of retained earnings and common stock. Okay. Then we're going to prove our cash. The cash that's listed here under assets, we're going to prove it. We're going to make sure that it's actually the right balance. How? We're going to take all our cash transactions related to operating, add up every plus cash, in other words, every debit to cash that's related to operational, meaning that your customer paid you. Anytime money is coming in, cash is typically coming from your customer. So you're going to plus money coming in from your customer. Then you're going to add them all up, get a subtotal, and plug the subtotal here under from customer. Then you're going to add up all the minus cash that's related to paying a bill, accounts payable or wage payable or something like that, and or your expenses. And you're going to subtract them here. The 2 numbers should give you the net amount of operating expenses. Next, you have investing. Investing, you're going to buy or sell fixed assets like land, like a building, like equipment. So more than likely, you're going to buy versus sell. Selling them, even if you do, is not going to be more than your purchase of new equipment, because this is older equipment that you're selling at, at salvage. So therefore, this number is almost always negative. And usually it's only one transaction for the things that we're doing in class. Last type of cash is financing. You have to have, in order for this statement to not frighten you, especially when we get to the end of the class and we have a whole chapter on it so you can do well, you just have to understand what defines operating, what defines investing, and what defines financing. Financing is how we finance, how we pay for things in our business. We pay for things in our business because we have multiple owners that own shares of stock. They give us cash so that they can have a piece of ownership of our business. We in turn pay them out dividends. Usually this is one transaction each in your classroom examples. Sometimes every now and then it might be more than one, but typically it's just one amount for money coming in from sale of common stock and one amount for money going out for dividends. Again, you subtotal each type of cash: net amount of operating, net amount of investing, net amount of financing. Add those three together. Then you'll add that amount to the cash beginning balance. This should equal your cash ending balance, which should be the same as the cash over here in your balance sheet. Again, watch the Cengage videos. Make sure you have a good understanding of financial statements, as this is the primary result of doing accounting. Again, we're going to review the economic transactions. Why? Because some of you are still struggling in this area and you need to be reminded to actually read. Read it as if, treat each of these things that we're doing in this class as if they are word problems that you had in your math classes in the past or science classes. You have to read it to know what's going on. That's why you're looking for the subject and the verb. Who and what did they do? Who makes a huge difference. If the owner does it, then it's going to affect common stock. If the customer did it, it's going to affect accounts receivable and probably revenue. If you, the owner, did it again, it could affect your liabilities. So it just depends on who did it and what they did. Then from that, you're identifying two or more accounts that are affected. Always two. More than that is a compound transaction. When you have a compound transaction, you need to make sure that you balance your debits with your credits. You determine whether those accounts increased or decreased. Once you figure out if they increased or decreased, then you can determine if they have a debit or credit entry based on dead coil, the normal balance side. Then you journalize it, record it, that is, on a general journal. You repeat this process: read, identify, determine, journalize, until all of the monthly transactions are complete. Then after you've done all 30 or 31 days, however many transactions you have, then, and have posted them to the ledger as you go, you'll have balances now at this point. You're going to take those balances and you're going to create the unadjusted trial balance. Okay. Then we're going to have adjusting entries. That's where we are right here. So after we post, we know we had an unadjusted trial balance in here, so don't forget it. These are just your things you have to do. Okay. Next, you have your journalizing and posting of adjusting entries. Then you're going to have adjusted trial balance in here, so make sure you add that in. And then you're going to create your financial statements. You're not done, because we still have chapter 4. We still have to close the month. Adjusting journal entries. So you're already journalizing on a journal. When you get down to the last month's transaction, you draw a line and then you write adjusting entries. Why do you do that? So that you yourself know that I'm doing my adjustments now. Once you do your start your adjusting entries, they're all dated the 31st or the 30th, whatever the last day of the month is. If it's February, then it'd be the 28th or 29th, depending on if it's leap year or not. So you're continuing. The balances in the ledger should be up to date. That's why you balance as you go, so that you don't have to go back and try to figure that out. If you try to do balances or totals at the end all at once, you'll confuse yourself even more. Okay, so on the same ledgers and on the same journal, you're continuing. You're writing the heading, adjusting journal entries. You have deferrals, you have accruals. We talked about this. Deferrals is a delay in time. What happened? You bought some supplies at the beginning of the month. You used them over time throughout the month. And at the end of the month, you did not have the same amount you started with. So you have to adjust for that. The beginning of the month, you prepaid some insurance. By the end of the month, the insurance has lapsed. In other words, you pay for a month of insurance, and at the end of the month, now the insurance company can earn the revenue of the cash that you've already given them because you prepaid it. So therefore, you would have to do an adjustment entry. Accumulate is accrue. So in other words, it adds up over time, just like you accrued revenues and you accrued expenses. Over time, you will do that. There are three notes here. Note number 1, There are various types of revenues. I've said this before, and I'm going to say it again. Fees earned just happens to be the author of your textbook's favorite revenue to use. It is not the only way. It is one of the ways that people earn money. Okay. Doctors earn fees, attorneys earn fees. So there are more people that charge a fee. Although there are sales, there's commissions, as the examples we had, dry cleaning revenue, there's rent revenue, there's other ways to earn revenue. So keep that in mind. Note number 2, cash is not a part of adjusting entries. Cash is a transaction that you will do during the month. Once you get done and get to your unadjusted trial balance and ready to do adjustments, cash is no longer an account that you will use from your chart of accounts. So if you find yourself writing cash when we're doing adjusting entries, know that you're doing it wrong. Note number 3, depreciation is expenses is the use of your fixed asset. What does that mean? That means that every time you expense the use of your fixed asset, you have earned money doing it. How so? You bought a delivery truck to make deliveries. Every time you drive it, you're driving more miles to make deliveries. You've accumulated those miles. There is a certain amount that you can use to write off those miles. So let's, for example, say it's 15 cents a mile and you use 10,000 miles. 10,000 times 15 cents a mile is how much you can write off for having used that truck to earn revenue. This is the matching principle. If you use the truck, the asset that you purchased, in order to earn a revenue, it is an expense that you accrued to earn the revenue. So it has to be expensed. Okay. So it does not change the value of the asset, the truck. If you pay $43,000, like in the last example we did in chapter 2, then it does not change that you pay $43,000 for it. What it does is has another account set aside for every time you had an expense. So every time you had an expense, you get to write off some of that $43,000. Okay, over time, pays off in the long run. The journal entry is always a debit to depreciation expense and a credit to accumulated depreciation. And accumulated depreciation is a contra asset. It will be hyphenated to modify whatever asset it is modifying. So for example, if the fixed asset, which this is related to fixed assets, plant, property, or equipment is PPE, then you will have a building. You may have a factory. You're not going to appreciate. Land is something you do not depreciate. It appreciates. So we will not do anything with land. You will do more things with things like land when you take intermediate accounting. So here we only focused on buildings, properties, trucks, equipment, machinery, stuff like that. So accumulated depreciation will be hyphenated machinery, hyphenated office equipment, whatever it is that is modifying. When you look under assets, you should see an account called office equipment. So therefore, when you take office equipment, let's say the truck, for example, let's go back to that, was $43,000 as an asset. Your accumulated depreciation had accumulated depreciation hyphen truck. Let's say it said $3,000 is your depreciation. When you take the $43,000 worth of the value of the truck that you paid for it, subtract $3,000, now your book value for accounting purposes, not blue book purposes, don't mix the two together, is $40,000. So this contra asset allows you to have to calculate book value. Contra meaning an asset has a normal balance of a debit. A contra asset has a normal balance of a credit. You will have other contra assets. So let's look at our adjustments. We have 4 types. We have prepaid expenses, unearned revenues. Both of those are the deferrals. We have accrued revenue and accrued expenses, which both of those are the accruals, hence by the beginning of the word being accrued. The accrued revenues and expenses is what we've been doing already. Accrual-based accounting means that we can recognize revenue when we finish the job. We can recognize the bills that we owe, the expenses that would need to be paid once we incur them. In other words, once you went out and bought something on account, you owe the money. Okay, so those are things that we've already been doing. Prepaid expenses and unearned revenues, you've also been dealing with, you just didn't realize it. So prepaid expenses would be something like supplies. You bought the supplies at the beginning of the month so that you can use them over the month, during the month. So that means at the end of the month, you will not have the same amount you started out with. And you know that from the two examples we've already done. This is a deferral. There's a use that is delayed. You will debit whatever the specific expense would be. So if it was supplies that we were dealing with, then it would be supplies expense. If it were prepaid insurance, it would be insurance expense. The credit would be the asset. The asset would be supplies. The asset would be prepaid insurance. What you debit and what you credit does not change. It stays the same. It's always going to be some kind of expense, and it's always going to be some kind of asset. It's always going to affect, one transaction is going to affect the income statement, the other transaction is going to affect the balance sheet. So you have to know which of these, expense versus asset, is on the income statement and which is on the balance sheet, because that could be a question that you're asked. Unearned revenues means that when you first recorded, back when you did the monthly transactions, someone paid you in advance. Let's say that you are an attorney and somebody paid you a retainer fee at the beginning of the month for some work that they anticipated you to do over the month. Did you do the job? No. Do you owe them the job? Yes, because they paid you in advance for a job that you will do, that you have not done yet. That makes it a liability. So unearned revenue, when it originates, is a liability, something you owe. So it has a normal balance of a credit. Once you earn the money, because remember the job is delayed, once you actually complete the job, you've earned some of this money that's sitting here. So now you can make an adjusting entry to show that you earned some of your revenue. How so? Well, you increase revenue with a credit, and you decrease the liability, unearned revenue, because remember the liability is that you owe them the job, you owe them the service, you owe them the product, like a magazine subscription. So study more on this, because you will see this more and more and more, and you need to be able to unpack that. Accrued revenues, like I said, this is something we've already been doing. Once we complete a job, we have earned the revenue. Therefore, we get to increase revenue. Typically, it's going to say unbilled when it's accrued revenue, because if it's accrued revenue, cash is not involved. Remember up here, cash is not a part of adjusting entries. So if you see that you completed a job, it is automatically accounts receivable when it has to deal with adjusting entries. It will never be cash here. Okay. And remember, the revenue is whatever way we earn revenue. So if it was fees earned, it'd be fees earned. If it was sales, it'd be sales, etc. The last one is accrued expenses. You've added up or accumulated some expenses and you haven't paid them, like the dry cleaning expense bill that we got in the mail, but we had not yet paid it. Okay, that makes it an accrued expense. So anytime you add up expenses, you increased your liabilities. So your liability is going to increase and your expenses are going to increase. So in this case, let's say that for the dry cleaning expense transaction that we had in chapter 1. So dry cleaning expense will be the debit. The liability is accounts payable, because that's who you owe. Now, of course, everything is not dumped into accounts payable in reality. There's going to be different accounts listed under accounts payable. So if that is Home Depot, Office Depot, Lowe's, or whoever all that you bought something from for your business, those are your accounts that you owe. Those, if you owe Visa is going to be under there. So those are all your accounts payable. It's just grouped together in here to help make the concepts more simple to understand. Okay, hopefully you get the adjusting entries and are able to apply this to some of the exercises and that the exercises actually make sense. Remember, after you journalize each type, you're going to post them to the ledger and calculate new balances for each of the accounts affected. Again, it's going to affect one balance sheet account and one expense account, income statement account. So you have your revenues and expenses that are on your income statement. You have your assets and your liabilities and your unearned revenue that are on your balance sheet. Those things you should have already picked out. Hopefully, I'm just solidifying it for you. Some additional concepts is the adjusted trial balance. So remember, after you calculated a balance in the ledger, you're going to go and list them again, and you're going to change the title this time to adjusted trial balance. This lets the person who looks at this know that you updated all of the balances that were affecting your income statement and affecting your balance sheet. Once you've listed them, all of your debits should equal your credits if you list them according to the normal balance, according to Dead Coyle. If you look in your textbook, I believe these are the accurate pages. If it's not, it's real close for your adjusted trial balance. Book value. I mentioned that earlier. Whatever the value of the asset is, cost concept, you cannot change what you pay for it. Therefore, they being the governing bodies of accounting, financial accounting standards, boards, etc., they created an account, a contra account, accumulated depreciation. This is going to hold all the depreciation that you've accumulated over the years for whatever the asset is. When you put the two together, cost of the asset minus accumulated depreciation, you get book value. So book value equals whatever the original cost of the asset is minus whatever has been accumulated to date. This accumulated, we'll do a whole chapter on this. So make sure you get a good general understanding of it now so you're not totally confused there. Here's an example. We have some equipment that cost us $250,000. The balance in the accumulated depreciation account is $12,000. What is the book value? So basically, I'm asking you to take $250,000, the cost, plug it in here, minus $12,000, the accumulated depreciation, plug it in here, and tell me what book value is. What is X? I'll give you a few seconds. Okay. And by now, you should have your answer. And if anybody guessed it, hopefully, yes, no. Remember, you should be doing these things with me if I'm doing this for you. You should have 238,000. Now, to practice some of the concepts that we've talked about so far, you need to do exercise 1, exercise 2, exercise 8, exercise 19, exercise 23 at minimum. At minimum. What do I mean by that? In between there, at the end of the chapter under exercises, you're going to see some problems that says, if this were omitted, if this adjustment was omitted. Those are the ones you really need to spend some time with, because that tells you whether you understand how to adjust and why you need to adjust. Because the why will help you answer questions about this chapter. Now, I have a bonus problem for you. It is PR 4-5A. It is in your textbook. It is on page 215. I would like for you to complete steps 1 through 7 using the Excel template. Again, the Excel templates can be downloaded from Cengage, Study Tools, or Student Resources. It can also be downloaded from eCampus chapter folders. You can download all of the author's Excel templates, so therefore you already have them when I ask you to use one. From this point forward, we'll write very little. Hopefully now you're connecting the dots and are able to kind of figure things out. And if you're not and you still need to print, then you need to print these templates for yourself. Remember, you have to set the pages because they are not designed to be printed. So you have to create the page that you want to print by doing print preview and then playing with the page setup. You can skip the worksheet. So those of you who had high school accounting, you completed a worksheet For this class, you do not have to complete that because it is double work. So basically, you will be doing steps 1 through 7 minus step 5. You should be able to do this. If you have problems, because you're journalizing from beginning to end, so this is a complete accounting cycle. You're journalizing everything from the beginning. You're posting everything from the beginning to the ledger. You're getting unadjusted trial balance. From there, you're going to do the adjusting entries, and then you're going to get the new adjusted trial balance. From there, you should be able to do financial statements. Now, realistically, because you have other things going on this weekend, I know you will not be able to finish the whole thing. Do I want you to make a good attempt? Yes. Why? Because it's going to tell you and it's going to tell me what you don't understand. It also is going to allow me to seamlessly explain closing entries for Chapter 4 to you. So take some time, practice these adjusting entries, make sure you understand Chapter 3, and then do this review problem. When I say bonus, I don't mind giving a bonus. I give more when you do more. So we'll see what you come up with when you come to class on Monday, what you actually have for me. And hopefully you have a bunch of questions and a good attempt written on your paper or typed into your spreadsheet. If you print this off and write it out, please do yourself a favor and use pencil. Thank you.